So let us go ahead and take on question number 16 from the worksheet. Now all these while we did examples where the employees work for 3 years and then the options vest, or they got to work for 2 years and options vest, right? And those are known as something called the cliff vesting, where all the options will vest at the end of a certain period, right? That is called cliff vesting. Cliff vesting is a type of vesting schedule where the employees will have all their options vested all at once. That is example, after rendering service for 3 years, all the options will vest. Is that fine? That is called cliff vesting. But this example is on something called the graded vesting, where a certain number of shares will vest after 1 year of service. Another lot of shares will vest after 2 years of service. Another lot after 3 years of service. It's called what? Graded vesting. So now we shall take on an example on graded vesting. Question number 16. Yes, ma'am.
Question 16.
You're wearing the mic?
Yes, sir.
Okay.
The following particulars in respect of stock options granted by a company are available. Number of employees covered 400. Number of options per employee 60. Nominal value per share is 100 and excise price per share is rupees 125.
It is given that there are 400 employees to whom these options are granted. Okay, we are the company and we have 400 employees to whom these options have been granted. Is that fine?
Yes.
And then what is given? It is
number of options per
options per employee, 60 options. That means each employee has an option to buy 60 shares in the company. And then it is given that
the nominal value.
Face value of 1 share is rupees 100 that will be allotted to the employees on exercise. And the employees will have to pay rupees 125 for every share they are going to buy from the company. It's not free. What is that called? It's called the exercise price, technically. Also known as something called the strike price, which you'll learn in AFM. But remember, that is the price at which the employees can buy shares in the company in case they decide to exercise a right to buy shares. Understood? And that is an exercise price. Now read further.
Shares offered were put in 3 groups.
You know the 60 shares that offered are put in 3
Groups.
buckets. G1, G2, G3. What is G1?
Group 1 was for 20% of shares offered with vesting period 1 year.
Very good, right? So what is 20% of 60 shares? The employees will have the right to buy 12 shares in the company after rendering just 1 year of service. That's a service condition, just 1 year. That means 12 options will vest after 1 year of service. Understood? Then G2.
Group 2 was for 40% of shares offered with vesting period 2 years.
What is the meaning? 24 shares or 24 options will vest, or the employees will have the right to buy 24 shares in the company after rendering 2 years of service. It's a 2-year vesting period. Next, G3.
Group 3 was for 40% of shares offered with vesting period 3 years.
You saw another 24 options will vest, or the employees will have the right to buy the balance 24 shares after rendering service for how many years? 3 years.
3 years.
You get it? So basically the deal has been sweetened. Just imagine 60 shares after working for 3 years. They have to work with us for next 3 years. The very thought is depressing, right? Like an articleship period. The same auditor for the next 3 years, or now it is
2 years.
2 years. What a relief. Fine. No one is answering. Okay, good. Don't. Fine. If your boss happens to see the lecture, they might be disappointed. But even they know. So here, please remember 3 buckets, G1, G2, G3. Got it? Next.
Fair value of option per share on grant date was rupees 10 for group
You
1.
know, the options of fair value will differ because the time differs, right? 1 year, 2 years and 3 years. Now, what is a fair value of a option that is a G1 option? It is rupees 10.
10.
It is rupees 10. What is the meaning? For example, suppose shares are trading at 135. The employees have an option to buy at 125. So 10 rupees a benefit, right? But that is not the way it's calculated. That is why the value differs, right? 10 rupee for G1, for G2.
12.5 rupees.
Because the time value of money, right? The present value. And what is the G3 value?
Rupees 14.
That means G1 options are worth how much? Rupees 10. These are options fair value. Fine. And there are option valuation techniques. Example, I said, Black-Scholes, Merton formula. 3 people. Fisher Black, Myron Scholes, Robert Merton. Okay. So that formula can be used to determine the options fair value. There's one more model, something called the binomial option pricing model. Fine. So don't bother. You learn all this in advanced financial management. But in financial reporting, these values will be given to you straight away. So you just have to take it and use it. Okay. So rupees 10, 12.5 and 14 rupees. Next.
So they are given a tabular data.
Now they are given a table. Okay. Read what are the columns.
The first column heading says position on first year.
In the first year, right? Year end. Then second column.
Position on second year and position on third year.
Now you read only for the first year.
Okay.
Now guys, we're going to do this way. Modus operandi. I'm explaining the method of working now. Now how we are going to operate. We'll read the data for year 1. Okay, year 1 fully you read. Then we shall read in the solution, read the working note to find the employee benefit expense for the first year, right? And also in this example, what is the requirement, Sneha? Finally, prepare.
1 second. Compute expenses to recognize in each year. And show important accounts in the books of the company.
What are the important accounts? We create normally 2 accounts, right? One is employee benefit expense account. Other one is a share-based payment reserve account. Also known as what? In day to day, I can say it's a share application money. Or some people say share options outstanding account. It's all the same. But nothing but like application money, we are collecting what? The 10 rupee or 12.5, not in cash, through employee service. They got to break their sweat. You get it? Got it? Now, read the data for year 1 alone. Then what we'll do, Sneha?
Yes, sir.
We'll go through the working for year 1, the expense.
Yes, sir.
And also see the ledger account for year 1. Is that fine?
Yes.
Yes.
Okay. The content says number of employees left 40.
That is what out of 400 employees, by the time you reach the year 1 end, 40 employees are left. They could not stand even for 1 year. They left. So that means what? Only 360 employees would have satisfied the 1 year vesting condition for G1. Yes or no?
Yes, sir.
Then how many are expected to leave in the second year?
36.
That means what? At the end of first year, we predict what? Another 36 leave in the next year. That means what? 360 minus 36. Only 324 employees are expected to satisfy the vesting condition to enjoy the G2 expectation. And how many are expected to leave in the third year?
34.
Another 34. All these are what? Estimations made at the end of first year. You get it?
Yes.
It is a bit confusing, but not all that difficult, right? So, please. So, what is 324 minus another? 34.
290.
290 employees will satisfy or are expected to satisfy the 3-year vesting condition. Yes?
Yes, sir.
Now, how to find the expense for the first year? Please go to the, that's it, no data?
One more, sir.
One more line.
Employees exercising options in group 1 is 350.
Because out of 360 employees are satisfying the 1-year vesting, only 350 employees are exercising. What happened to the 10 employees? They would allow their options to lapse. Wonderful. That's a good word, right? That's the right word. Lapse. They would allow the option to lapse. Is that fine? Now please refer to the, what do you say? The working. Yes, ma.
Answer. So the first working goes
Year for year 1 working, right?
Yes, sir. Total number of options per employee 60. So for the group 1, it's 20% of
60 is 12. Then.
And then for group 2 is 40%,
Which is 24.
And for
And
group
G3,
40%
it is
again
24. And then
computation of expenses.
we are going to compute expense for year 1. Yes, ma, year 1.
Okay, year 1.
For G1, what I will do, take only 360 employees I will take. That into 12 options each. That will work out to 4,320 options would have vested. That into rupees 10 per option, the value. That into 1 by 1. Why? Only 1 year, no?
1 year.
1 by 1. That means to be expensed in the first year. What is the amount? What is 4,320 into rupees 10 into 1 by 1? 43,200. You find that number?
Yes, sir.
43,200. Guys, I'll go very slow. Okay. I understand, from your standpoint is quite, by now you'd have lost interest looking at the sum. Anyway, listen, 43,200. Very interesting sum and very important from the examination standpoint, right? So, 43,200. Then for the first year itself, for G2, what is the expense to be recognized? Another, how many will leave in the second year? 36 might leave, right?
Yes, sir.
300 are they taken 324 on the screen?
Yes, sir.
324 employees into 24 options each. That into rupees 12.5 into 1 by 2 because 2 years vesting. And this is the first year. Okay. So into 1 by 2. How much?
4640.
That is the amount expense for G2. And for G3, see, G2 doesn't mean you go to year 2 and recognize, right? It is across the service period. Got it?
Yes, sir.
Then G3, so G3 means third year, sir. No. Across 3 years. Because they are rendering service across 3 years. That means you want to collect the 14 rupees on G3 across 3 years. Through their service, right?
Yes, sir.
Now just see the third. For G3, you will take 290 employees are expected to satisfy the vesting condition. That into 24 options in that group, that bucket. That into rupees 14, value of one option, into 1 by 3. How much? 30?
32,480.
32,480. Is that fine?
Yes, sir.
Look at only year 1. Now add up all the three numbers. Only year one. Don't look at any other column, any other working. Look at only year one. Year one for G1, G2 and G3. All the three. Total how much? 43,200 plus 48,600 plus 32,480. Add up all the three numbers. How much?
1,24,280.
That is the amount to be expense in the first year. And for that, what is the entry? It is employee benefit expense account debit to share-based payment reserve, and the amount is
1,24,280.
But have in mind this 1,24,000 how much?
280.
Includes the 43,200 what we have collected on G1 from these 360 employees through their service. It's like application money collected in the form of their service. Apart from that, they have to pay even cash. Even the exercise, what? Another 125 rupees on application allotment, right?
Yes.
Got it?
So, sir, this is based on the estimate that 360 people would have vested.
No, the 360 is actual.
Actually.
Because 1 year vesting is already over.
Okay.
You know 40 left. See, for G1,
Yeah.
360 is actual.
Okay.
Whereas 324 and 290 are estimated from the first year angle. Because how will you know how many employees left in the second year at the end of first year? Unless you're Nityananda, you tell me.
Expense. Okay.
Unless you're a Swamiji, like a Bala. How will you know that so many will leave in the second year? It is only it's a prediction, right? It's a forecast. Got it?
Yes, sir.
That is why I said, read each year, go to the working. Otherwise, you will think, what is given in year 2 also what? As if you know that at the end of year, which is not true. The actual number of employees left in year 2 will come to know only in year 2. Yes or no?
Yes, sir.
Got it? Yes?
Okay.
Slowly, slowly you can go, no problem. Okay, will be the...
But sir, here it says
Yeah.
employees exercising the options is only 350, no? So that we will.
No, out of 360.
Okay.
Remember, out of 360 employees who were there at the end of first year, G1. Out of 360 employees, only 350 are exercising, and 10 employees, even though the options are vested, they did not exercise. Understood?
Yes, sir.
It is only for G1. It can't be for G2 because they have to work for one more year to exercise. For G2, 2 years vesting, right? What is Sneha?
Yes, sir. Yes, sir.
Out of 360 employees who are there at the end of first year, satisfying the G1 vesting condition, 1 year. Out of 360 employees, only 350 are exercising. The 10 employees decide not to exercise. This is happening at the end of first year, right? Once the options have vested. Which option? The G1 options are vested. Got it?
Okay.
Yes? Yes?
Yes, sir.
Please remember, after 40 employees left, 360 are there at the end of first year. They satisfy the G1 vesting condition. Understood? And minus 36, all are predictions. How many will satisfy the G2 vesting condition and G3. But here, now focus on G1 now. Out of 360, how many exercise that option? 350. And 10 do not exercise. Is that clear?
Yes.
Got it? Now, please remember, the entry is employee benefit expense account debit to share-based payment reserve account. Now, please refer to the ledger account, Sneha.
Yes, sir.
What are the two accounts I made?
Just a minute. Employee benefit expense.
This account is a dummy, nothing. Just see. To share-based payment reserve, how much? 1 lakh?
24,280.
Then by?
Profit and loss.
Exactly.
Brought from carry forward.
Is that even a +1 kid can do this? Transferring the expense to P&L. Now, let's focus on the next account. What is that? The share-based payment reserve account I want to focus. For year 1, yes ma'am. On the screen.
Yes, sir.
Just see, by employee benefit expense, 1,24,280, right? This amount includes 3 numbers rolled into one, right? Remember 43,200, 48,600 and 32,000 all put together, right? What is that 43,200? 360 employees into 10, into 12 options each into 10 rupees, right? 43,200.
200.
Now, listen carefully, Sneha.
Yes, sir.
Out of 360 employees, how many did not exercise?
10.
10 employees. Therefore, the amount of application money you have taken, the 10 rupee, on how many shares? 10 employees into 12 options each in that group, G1. 120 into 10 rupees. How much?
200.
1,200 rupees, which is collected but not. You have taken the money, but shares are not allotted, right? So, the standard says in para 23, when the options are vested but not exercised, the balance in the share-based payment reserve account can be transferred to or may be transferred to retained earnings or general reserve. No problem. Is that clear? Got it? Therefore, just say on the debit side, to general or to retained earnings, 1,200 rupees. Is that fine?
Yes, sir.
Now, wait. Now, when 125 rupees is paid on every share by the 350 employees, right? Take a calculator, 350 employees into 12 shares each. That means how many shares? 4,000
200 shares.
shares are bought by the employees. So, they bring in how much money? 4,200 shares into 125 rupees. How much?
5,25,000.
People ask me, sir, should I write bank account debit to share capital? If you want, you can pass it entry. Otherwise, what you can do, since you are preparing ledger account, you can transfer this money brought in also into which account? Into the share-based payment reserve account. Like bank account debit to share application. Yes or no? Think about it. You're +2. And application money to share capital, then to share premium, if any. People tell me, so you're wrong, so security doesn't matter. It's all the same. Whether you say share premium or it doesn't matter. You get it? You don't have to be politically correct. But exam, please write securities. In the classroom, it's okay. Fine, I can escape. So, please remember, by bank, that is the money brought in. 350 employees into 12 shares each into rupees 125. Got it? Now, major question. Sir, how to find the amount to be transferred to share capital and share premium? See, already a person, now bank account debit to share application, like that, by bank, in your share-based payment reserve account. Now, application money to share capital to share premium. How, sir? I'll tell you. To share capital, very simple. Very, very simple. We know 4,200 shares allotted. Hello, 350 employees into 12 shares each. I said 12 shares because options have been exercised now. Okay. So, 4,200 shares into rupees 100 face value. How much? 2 share capital, 4 lakh in.
20,000.
You find that?
Yes, sir.
Sir, how to find the premium, sir? I'll tell you. Now, how much is the application money paid by these employees? They paid 125 in
25.
cash. And how much it took in the form of service? Remember, 10 rupees.
Okay.
Yes or no? The options fair value. You have taken 10 rupees in service, another 125 in
Cash.
In all, how much? 135 rupees are collected. 135 are collected. Shall I prove that? 135. Shall I prove that? Okay, check this. Just say buy the same account. Buy employee benefit expense, how much?
1,24,280.
Very good, Sneha. That includes 43,200. Remember?
The
Expense for G1.
Yes, G1.
Expense for G1 in the first year. 43.
200.
Of this 43,200, how much has been transferred to retained earnings? 1,200 not exercised. What is the balance left?
42,000.
Exactly. Take a calculator. Add 42,000 and buy bank how much? 5 lakh?
25,000.
Add both.
5,67,000.
Now divide 5 lakh and 67,000 by 4,200 shares.
135.
What a magic. So 135 is nothing but you are taken 10 rupees in, not in cash, in the form of their service. And the balance 125 in cash. You get it, huh?
Yes, sir.
Got it? Yes? Out of 135 rupees, 100 is transferred to share capital and 35 transferred to securities premium. And 2 balance carried down. What is the balancing figure? It will be equal to know what? Remember the expense recognized for G2 and G3? 48,600 and 32,000. If you add both, that will be the balance carried down. Because that those options have not yet vested. Yes or no? Understood? 2 balance carried down how much?
8180.
Very good. So what do you do, guys? Go have a drink. Okay. Drink means coffee or tea, whatever. Okay. And then work out for year 1. Will you do it?
Yes.
You can pause the recording. Come see, do this way. Open 2 pages. Okay. First page, all the workings. Year 1, we are going to do first, then year 2 and year 3. Second page, open the share-based payment reserve, the ledger account. Forget about the expense account. That is easy, right? See, I am not bothered about expense account, but do the examination. But here, that is nothing. Every year transfer to profit and loss. Will you do that?
Yes, sir.
So, complete the share-based payment reserve account. Very important. Understand how the numbers you get. Fine, how you get those numbers. So, just pause the recording, Sneha, and work it out.
Yes, sir.
Now, let us go ahead and take on year 2 now. Let's read the information for year 2. Yes, ma.
Just a minute. Yes, sir. So, position on second year.
At the end of second year.
Employees left is 35.
That means what? Remember, already 40 left in the first year, making it 360. Minus another 35. So, 325 employees will satisfy the 2-year vesting condition relating to G2, right? This is the actual number of employees, 325.
25.
Then,
Estimate of employees to leave in year 3 is 30.
he has given that because for you to find the G3 expense. Out of 325, which is the actual number of employees end of year 2, another, how many?
30.
30 will leave in the, expected to leave in the
Third
third year. Leaving a balance of 295 will be taken for computing expense. Next.
Employees exercising options in group 2 is 319.
What is that? Out of 325 employees who are there at the end of year 2, only 319 employees are exercising their option, and the balance 6 employees allow their option to lapse. Is that fine?
Yes, sir.
Now let us go to the working. Just see for year 2. For year 2, have they done once again G1?
No, sir.
They put G1, no.
No.
We'll take only G2 and G3. Look at G2, okay. Now what I will do, 325 employees are actually there, right? Just see the working, 325 employees. That into 24 options in this group. That into rupees 12.5 per option, right, Sneha?
Yes, sir.
Into 2 by 2, because what? 2 years vesting and we are in the second year. Into 2 by 2 will be the cumulative amount of expense to be recognized.
Okay.
How much you get?
97,500.
But of this, how much has been already expensed in the first year?
48,600.
The balance will be
Recognized.
how much? 40?
8,900.
Will be the expense for the second year for G2. Now G3. What I should do? I will take 295 employees are expected to satisfy the vesting condition, right?
Yes.
After minusing 30
Yeah.
expected leavers. So 295 employees into 24 options each, that into 14 rupees, into 2 divided by 3, because out of 3 years, 2 years over. So into 2 by 3, how much I get?
66,080 rupees.
From this, you minus 32,480 already expensed. How much you get?
We get 33,600.
That is an expense for G3 in the second year. Understood?
Yes, sir.
At both.
Rupees 82,500.
That is a total expense for year 2. Understood?
Yes, sir.
Now let's go to the ledger account. Just see the share-based payment reserve account. I'll focus on that. The expense account you can manage, right?
Yes, sir.
So just see on the credit side, buy balance brought down. How much?
81,080 rupees.
Very good. Then buy employee benefit expense. What you got for the current year? How much?
82,500.
500 is it?
Yes, sir.
Okay. Then remember 6 employees did not exercise their option in G2. 6 employees into 24 shares each, 24 options lapsed. That into rupees at 12.5 what you have collected in 2 years, which is anyway cancelled. How much?
1,800.
Will be transferred to retained earnings. You find that?
Yes, sir.
It is share-based payment reserve account debit to retained earnings 1,800. Then by bank amount brought in 319 employees, Sneha.
Yes, sir.
That into 24 shares now allotted into rupees 125. What is 319 into 24 by the way? 319 into 24.
319 into 24 is 7,656.
That means that is the number of shares allotted to them. That into rupees 125.
Into 125 gives you 9,57,000.
Exactly. That is the amount to be brought in by these people. Have they shown by bank?
Yes, sir, by bank, yeah.
Okay. Now, how to find the share capital share premium? Very simple. Now, tell me how much would have taken from these people in the form of their service? 12.5.
5.
Another 125 in cash. Yes or no?
Yes, sir.
In all, you would have received 137.5.
Okay.
Of that, 100 will be transferred to share capital. 37 rupees and 50 paise transferred to securities premium.
Premium.
Understood?
Yes.
Just see on the debit side, 2 share capital will be 7,000. How many shares you got? 319 into 24.
7,656.
That into rupees 100 each. How much? 7 lakh.
65,600.
Very good. Then two securities,
Security
premium. Nothing but the number of shares into 37 rupees and 50 paise.
Okay.
Understood? Will be the balance transfer to share premium. And then now two balance carried down will be how much? 66,000.
80 rupees.
What is that? Nothing but that is a expense accumulated for G3 for the 2 years. Remember 32,480 and 33,000. Your working note 2.
33,600.
Adding both. That is the amount carried forward. Got it?
2,480 plus 30.
Plus 33,600. You'll get that.
Yes, sir.
Trust me. Okay. So two balance carried down. Got it? So guys, please go ahead and complete the working for year 2 and also the ledger account for year 2. Is that fine? You can pause the recording one. Okay, now let us go ahead and read the data for year 3, Sneha. Let's go back all the way to the question, read year 3 data.
Yes.
Yeah. Take your time.
So question on third year, employees left is 28.
The employees left another 28. Remember, out of 400 employees, 40 left in year 1, another 35 in year 2, another 28 in year 3, leaving a balance of 297 employees are actually there at the end of year 3. Understood? Next.
Then employees exercising options in group 3 is 295.
Out of 297 employees, only 295, right?
Yes, sir.
Exercise. So 2 employees allow their option to lapse. Next.
Yes, sir. That's all for
That's
year
all.
3.
Now let's go to the working. Just see for year 3 expense, take only G3. Only G3.
Yes, sir.
Just see the working. 297 employees are actually there. Right?
Yes, sir.
That into 24 options in this G3 group, right? Group
Yes,
3.
sir.
So G3, I shouldn't say G3 group, right? G3 is to group 3. It is 297, that into
24.
24, that into rupees 14 into 3 by 3. How much you get?
To 14, 99,792.
That is a total amount of expense to be recognized across 3 years, cumulative. Of this, how much has been recognized already in year 1, year 2? You subtract 32,480 and 33,000
600.
minus, or you can subtract 66,080. That's it.
33,712.
Is the expense for the third year. Have they shown that?
Yes, sir.
Now let us go to the ledger. Just see on the credit side, buy balance. Buy balance brought down 66,080 on the screen.
Yes, sir.
And then buy employee benefit expense. What you got for the current year? How much? 30?
33,700.
Very good. Then let's find the retained earnings transfer. Remember, 2 employees did not exercise that option.
Yes, sir.
So 2 employees into 24 options each
Into 14.
into rupees 14 will be transferred to retained earnings. Please remember, once the options are vested and not exercised, will be transferred to retained earnings. It can be maybe transferred to general reserve. It's up to you. How much, ma?
672 rupees.
Very good. Then buy bank. So how many shares are bought? It is 295 employees into 24. How many shares?
7,080 shares.
So 7,080 is it?
Yes, sir.
That is 295 into 24.
Yes, sir.
7,080.
80.
Okay. That into rupees, how much?
Into 125.
Exactly. How much you get?
We get 8,85,000, sir.
Have they shown that?
Yes, sir.
By bank. So how much will be transferred to share capital? You take 7,000. How many shares? 7,080 shares. Into rupees 100 will be transferred to share capital.
7,08,000.
Then how to find the share premium? Very simple. We would have collected 14 rupees through their service. Plus another 125 collected in cash. In all,
39.
All that 100 has gone to share capital. Balance
39.
39 rupees into number of shares will be transferred to securities premium.
2,76,120.
Or you can also have it as a balancing figure. Because there's no other balance carried down. You get it?
Yes, sir.
So guys, with that you complete year 3. Got it? This is an example on graded vesting.
Vesting.
And not, what is the other term? Cliff vesting.
Cliff
Okay? Where all the options vest after a certain number of years. But here, gradual vesting. Got it? Now please go ahead and work through year 3. Do the working and also prepare the account. You can pause the recording. Okay, so guys, with that we complete the example, but have in mind whether the options are exercised or not, the options are vested will be taken for calculating the expense, right, for that particular year. And once the options are vested and not exercised, then you will be transferring the amount that has been collected from the employees through their service to retained earnings. It will be transferred to retained earnings, right? Got it? Have that in mind. Example, in year 1, remember, 360 employees satisfy the vesting condition. Got it? Or that 10 did not exercise. That doesn't matter. You find expense based on 360 employees. Options vested, 360 into 12, right? And then you transfer to retained earnings. The 10 employees into 12 options are not exercised into rupees 10 will be transferred to retained earnings. Have that in mind. Okay? So we'll end the class, Sneha. Pause the record.